So we are now on record, maybe for the benefit of those who might be accessing we are saying that dual entry concept or the double entry concept is where for every debit entry, there must be a corresponding credit entry for the books of accounts to balance. So we have an illustration there of an account, and this is where we'll be doing what we call the journal entries. Or when the examiner asks you to journalize, this is the journal in accounting. And the need of the journal, a journal is really a summary account where you do your debit and credit entries before you push them to the necessary books of account. And we have only three. We have what we call the balance sheet, and balance sheet is nowadays called a statement of financial position. Then we have what we call the profit and loss account, and the profit and loss account is called a statement of comprehensive income. And then the other book is the trial balance. So we have three books, and this is the books that will be now from the trial balance. You are able to transfer all the items now to either the statement of the comprehensive income, and later on that information is transferred to the balance sheet to show the correct and right position, all the true and fair view of the business, a given period of time. So we go on. Now, these columns are all the way the journal is labeled. We have the column for date, and this is where you record the date of entry or the date of transaction. At times could be you are just bringing down the balance that had remained in the previous books. When you go to another new year or another new period of transaction, you bring it in. But basically, it's supposed to record the date of entry into the journal. Then the details will be talking of the corresponding book that will be affected. Then folio is more of reference. You can imagine in a supermarket where we have 1,000,001 items. If we don't have the folio number, we may not know which particular item we are selling. For example, you have so many brands of cooking oil. So are you selling the cooking oil from Bidco? Is it from Pwani? Is it from? That's why we need the folio. Then of course the amount. So while generalizing, we'll tend to avoid the folio, but folio is generally systematically generated for those institutions that are using the accounting systems. So we go on. So the folio column is supposed to record the reference, and of course we have the amount of the transaction that is held. I know it's jumping. So I've said the left-hand side of the book is called the debit side, and we normally denote it as DR, whereas the right-hand side is known as the credit side. So all assets are recorded on the debit side. Liability and capital items are recorded on the credit side. So each type of asset or liability must have its own account. When we come now to the journal entries, it is prudent that every transaction is recorded on the independent journals. So you'll be having different journals: premises journal, plant and machinery, stock, debtors, creditors, bank, cash, name them. So any other transaction that falls your way needs to be journalized in its independent journal. And this is to avoid confusion when you'll be transferring the balances to either the statement of the comprehensive income or the balance sheet. We go on. So for double entry to reflect in the accounts, this is what I was talking about. Every debit entry must have a corresponding credit entry. And this is when we say that a dual entry has been done. So for every debit entry, we must have a corresponding credit entry. That's the meaning of double entry or dual entry concept. So the transactions that are affecting the books will normally affect either when we increase or we decrease the amount of that particular ledger. I've indicated here a summary when we make a debit entry, we either increase the value of assets or reduce the value of liability or reduce the value of capital. So you can see when the debit happens. Yeah. Let me give an example here and say, let's say Kamau, let me just indicate here. Kamau deposited 10,000 shillings to his bank account to be capital. I'm just giving an example. To be capital. So that is Kamau. So what is happening? We are seeing Kamau depositing 10,000 into his bank account. A bank account is an asset. So let me just use a different color for purpose of understanding. This is an asset. Then capital is capital. I don't even need to indicate. So what is happening? Kamau deposited 10,000 in bank account. So he's increasing the value of his bank account, which is an asset. When the assets increase, they are debited. So allow me to use DR to denote debit. I don't know what is happening. In other words, let me not disarrange the notes, but I think understandable. In other words, we are saying Kamau deposited 10,000 to his bank account, therefore he increased his assets by 10,000. So we are going to debit that account. Now we don't have the liability in this particular case, but if we have, for example, let's say the amount that was deposited by Kamau. So we have a case where I want you to appreciate the double entry. Now, for it to be double entry, I have debited this account, which is an asset. So I debit. I come to capital account. I'm going to credit. Reason being, my capital is increasing. So we are talking of the items that will be affecting the debit side will either be those that are increasing the assets or those that are reducing the value of liability or reducing the value of capital. Now look at the next set of entries. When we make a credit entry, it's either we are reducing the value of assets or we are increasing the value of liability. Now suppose Kamau was paying a debt. Let's say Kamau deposited the 10,000 to pay creditors. What will happen? Creditors are liabilities. So liabilities will increase. So when liabilities increase, we are supposed to credit. But our cash will be reducing. So the value of asset will be decreasing. We are going to credit. Are we getting? So anything that increases the value of capital, for example, when Kamau deposited 10,000 to his bank account, we debited the bank account, but credited the capital account because we are increasing our capital by 10,000. I'm not very sure whether it's coming out clearly, but we have an illustration here to help us understand better. So here we are. H-Jump has the following assets and liabilities as on 30th November 2002. Creditors 39,500, equipment 115,000, motor vehicle 62,900, stock worth 61,500, debtors 57,700, cash at bank 72,800, and cash in hand 400 pounds. Compute the balance on the capital asset as at 30th November 2002. So there we are. So during the first week of December, Jump made the following transactions, year 5, and then you are to draw up a balance sheet on 7th December 2002 after the above transaction have been completed. Where do we start? Where do we start? Allow me to pull this question. I take it to control copy. I want to open an Excel account. An Excel, we work from the Excel. Somebody to confirm to me what they are seeing on the screen. Let me stop to share and share the Excel. So there we are. I have transferred the question to the Excel account for purposes of working. Yeah. So I want us to, can you see all the fonts are so, are you able to see?
Yes, we can see.
Okay. So I'll have on one side the assets, on the other side I'll have the liabilities. I want us to first record the balances that you've been given up there. So we start with, you'll be telling me the nature. So we have creditors. What are creditors? Assets or liabilities? Creditors are liabilities. Should have moved this a bit. I want to put it here. I'm providing for the column for putting the amount. So you say that creditors are liabilities. And the liability amount of creditor is 39,500. We go on. The next item is equipment. Equipments are assets. Let me just write EQT in the interest of time. And it is 115,000. Then we have the next item is motor vehicle. Just denote it as MV. And the value of the motor vehicle is 62,900. Then the next item is stock, your current assets. So current assets, the value of stock is 61,500. Then the next item is debtors. Debtors are current assets. They are amounting to 57,700. Then the next item is cash at bank. Let me just write bank. When you say cash at bank, you are talking of what is in the bank account. The value is 72,800. Then we have cash in hand. So this is cash, spot cash, which is in the pocket, it's 400. And that's all. Yeah. So the first thing that you are supposed to do, we've been told that compute the balance on the capital account as at 30th November. During the first week of December, JAMP did the following transaction. So even before we jump to December, we need to compute our capital. If you look at the question that we've been given, we've not been given the value of capital. But can we get it? Who can help us get the value of capital? You remember our equation? Our equation, assets is equals to liabilities plus capital. So can we make capital the subject of the formula? So our capital will be equal to assets minus liabilities, isn't it? Yeah, so we can get these totals. This amount. So I can get the totals and just use the formula. Just get the sum of what is in the column. So I scroll, enter. So this is the value of my assets. Yeah. So my capital will be equal to 370, 300 minus 39,500. What's the value of the capital?
330,800.
Wonderful. So it's minus this. So it is 330,800. Confirmed? So we have the capital figure, and that is what we've been asked in the first question. So you should always keep in mind that our formula will never change. You can alter the formula to get one variable. For instance, if we had not been given the value of assets, we could easily, if we had the liabilities and the capital only, we can easily get the value of assets by adjusting the formula accordingly. Yeah. So we've gotten the value of capital. So we can go on. And we told that during the first week of December, Jump bought an extra equipment on credit. I want someone to guide me. So what are we supposed to do? What is happening to our equipment? Guys, what is happening to our equipment? Are they increasing or decreasing? And this. What is happening to our equipment?
I think the equipments will increase since they are buying some.
Yeah, equipment is increasing. So what are we supposed to do when they increase? What are equipment? The assets, isn't it? Can we have the formula? Can we have the summary here? Because guys are losing it. We said when assets increase, when they increase, debit. When they decrease, just put it on the, me put it down here. When they decrease, credit. CR is the abbreviation for credit. We go to liabilities. For liabilities, you've agreed when they increase, we just copy this. Who has acquired? When liabilities increase, we are supposed to, are we crediting or debiting? We're supposed to do now the opposite. Yeah. And then we have the capital. And we say for the capital items, let me copy paste. Then we have for the capital items, when they increase, we credit. When they decrease, we debit. So you can forget everything else in this class, but don't forget these three. That when assets increase, we debit. When they decrease, we credit. When liabilities and capital items increase, we credit. When they decrease, we debit. That is double entry. Nothing much, nothing less. So can we go to the first transaction? We've been told, I was trying to push my B. Let me change this to, what is important, I'm changing to red. I wanted to move B. I'll have a problem. Let me move it from the question, the other end. This is a challenge of using the, we were on face-to-face, tungekuwa tushamaliza hii maneno. That's okay. So I've moved the B to its independent I'm trying to delete this so that I'm able to journalize. I want to journalize the transaction in the independent sentences. So there we are. So I'll do it here. So we've bought an extra equipment on credit. So you've said that our equipment will increase. So we are going to debit. What will happen to our creditors? Our creditors will increase. And creditors, the nature of creditors is liabilities. So when they increase, we credit. So you should make sure that for any debit entry, there is a corresponding credit entry. And you can see that. We go to the second transaction, bought extra stock by check. So you have stock are current liability, are current assets. So what happens to assets when they increase? Again, we debit. Then our bank account, because we are paying by check, will decrease. So we are going to credit. So you can see a case where assets are appearing in one sentence. We are buying stock by check. Our stock is increasing, we debit. Our bank account is decreasing, we credit. Because you said when assets decrease, they are supposed to be credited. Are we there? We go to the third one. Who will tell us what is happening? I've been talking all along. Who will tell us what is happening?
When we pay creditors by check, the creditors account will decrease. No, the bank, since they paid via check, the bank, the money, the cash at the bank will decrease by 7,900, and the creditors account will I think the creditors will increase also because they will decrease because a certain amount has been paid.
Now paid creditors by check. So once they decrease, what are we supposed to do? Creditors are liabilities, isn't it? When liabilities decrease,
it's debited.
Debit. Wonderful. Then the other account that will be affected, you said, is
Bank
account. So our bank is decreasing because we are paying. So when assets decrease, we credit. Wonderful. We go to the next transaction. Received from debtors. Let me put E in its place. Now I want someone to guide us on D. Received from debtors, 8,400 by check and 600 by cash. So it's like there are two transactions in one. Someone to guide us? I want to put this in its line for purposes of doing the necessary entry. Don't talk on the chat box. Talk to the class. Don't talk on the chat box. We won't listen. We won't hear you in the chat box. I'm now being forced to go and open the chat. Martin Ojuang. No, Marian Ojuang. Can you hear me? Marian seemed to have a problem. Marian seemed to have a problem. She can't hear us. So he'll give us the fourth transaction. We received from debtors 8,400 by check. Who are debtors? Who are debtors? Debtors are assets, isn't it?
Yes.
So we are receiving from debtors 8,400 by check. So what is happening to the bank account? It is increasing by 8,400, isn't it?
Yes.
So we are going to debit our bank account, our debtors. Our debtors will increase by 84. So we are going to credit. And we have 2 transactions in that account. Then 600 by cash. We are receiving 600 by cash. Again, our cash is increasing by
600.
600. Therefore, we credit the debtors account. And then, what am I doing? And then last but not least, we have so these ones will be decreasing, therefore credit. And then the last one, put in extra 2,500 in capital account. So ultimately our capital, our put an extra cash. So we are putting cash. We are putting an extra 2,500 to be our capital. So our cash is increasing by 2,500. Again, our capital will be increasing by 2,500. When capital increase, we credit. Is it now clear? So anytime when you get such a question, you are supposed to use a pencil or a pen of different color to try and analyze or journalize or put the affected account into perspective. And then from there, the reason why we are doing this is very easy now when we come to the entries, because I'll just draw the necessary ledgers down here and make the necessary entries. And I want to start with the equipment account. Maybe, yeah, the equipment account. Let us do it here. So this is the equipment account. Equipment. And in the equipment account, we said will be, this is our debit side. Let me just put here SDR. We said we have the dates. We have the details. You have the folio number, and then we have the amount. I'm leaving the folio number deliberately. Yeah, I can replicate this on the credit side. Control paste. So I just want to make one account for everyone to see. Ooh. See how it pans out. I'm trying to have made several. Just do it like this. So this is our account. This is supposed to be at the center. Let me merge these cells. So these are equipment accounts. So this is the DR side. Let me just indicate DR. This is the credit side, CR. So to just pushing it, I'm forcing it to move to the other side so that we are able to see. So there we are. So that is the illustration of our ledger. And we need now to do the necessary journal entry. Yeah. And our journal, we are in the, so we'll be picking all the items of equipment. And I want you to denote what happens. Now this will be, we've been told to prepare our books of entries as at the end of 7th December 2002. So at the date here, I'm supposed to denote that. So it is 7, is it 7 December or November? Who is having the question? When are we doing the books of account? Yeah, you are to draw up a balance sheet on 7th December. Yeah, compute the balance. So we are preparing our books on 7th December 2002. So I go back. So it is 7th December 2002. So I have equipment, and someone will ask me, how will I put equipment in the equipment account? Now, because this is equipment account, I don't expect to see any other equipment in this ledger other than what is at the top. So what we have is a balance that is being brought downward, and the balance is of 115,000. This doesn't look like money. Let me monetize it. Now that looks like money. So we are talking of a balance brought downward, normally denoted as BD, and the amount is 115,000. So anything else that will affect this book, anything else that will affect this book, let me monetize the entire column. So anything that will affect this book will be coming after the balance has been brought forward. So we had the balance that was brought forward or brought downward. Let me just call of brought downward because we are going to carry it downward in the subsequent books, now the balance sheet. Then we look at the journals to see any book that affected equipment. And if you look at the first transaction A, bought extra equipment on credit for 13,500. So the book that is affected is creditors. So this is how we journalize. So in the equipment account, on the same time, 7th December, I need not repeat the dates because we are closing the books. We have the creditors, we have the equipment worth 13,800. But this is affecting the creditors account. So I'm going to open a creditors account. And that is double entry now. So for any debit entry, there must be a corresponding credit entry. So I'm going to create another book here. Let me just copy paste in the interest of time. And I'll call this book Creditors. Creditors. Creditors account. And you realize the creditors that I'm talking about here are equipment creditors. So equipment creditors being fixed assets, I don't want to mix them with the regular creditors because assets are bought for purposes of generating revenue. So allow me to put in bracket here, equipment. Kindly mute yourself unless you are asking a question. Avoid interrupting the why my book is behaving this way. But okay, let me now delete this. So what is happening? The first transaction was we bought equipment worth 13,800 by credit. So when we come to this book on 7th December, I'm supposed to have a corresponding credit entry. So I'm going to have on 7th December 2002. Now the corresponding entry is affecting the equipment account. So I needed to take some time to demonstrate so that when it comes now to making the so there we are. So my journal entry is now complete. Any question? Any question? Wewe kama uongei, why don't you put yourself on mute? I want to copy paste all this. because I have different entries. Allow me to do that. These accounts are blank, so I want us to fill them as we go by to avoid confusion. So let me copy the blank. Paste. Trying to save time for the subsequent journal entries, so that once we go to the entries, we just need to pick and paste. So we are good. So you can imagine the kind of work involved, and that's why you are an accountant. All these you'll be doing. But nowadays, the accountants are more or less like technicians because we have accounting systems that have simplified this. For example, if you go to QuickBooks or Sage, once you debit one item, all the other corresponding books will be updated automatically. So you won't be doing it manually. But you see, you have to understand the concept so that you don't credit the wrong item. Actually, the system will not allow like to credit equipment because they know all assets are debited. You get? So we go on, we go to 2, bought extra stock by check. Somebody to guide us? Bought extra stock by check. So which books are we affecting? Bought extra stock. We even have the books here. You see the reason why we were summarizing. So we have the stock account and we have the bank account. So I'll come down here. One of my book will be stock account. The other book will be bank account. So it becomes easier. The stock was worth. What was the stock? What was the value? But before we journalize, we had a stock, we had a balance. So we have a balance brought downward of 61. This is the balance that is already in the account. And then we are buying stock worth, what's the value of stock? 5,700. So bank 5,700. And then the corresponding book that will be affected will be the credit side. So stock, we had a bank account. Bank has also a balance. We can put it here. Balance brought downward of, remember the opening balance. So our opening balance is 72,800. So for this particular entry, we had stock worth 5,700 being bought. So the book that is being affected here is stock account. It is 57. My O is misbehaving. Are you together, guys? We go on. I go to the next entry. C, paid creditors by check. So creditors account is coming up. Then we have the bank account. So bank account is already existing. I said we avoid using the equipment creditors account because equipments are, you know, the nature of creditors is for trading, but equipment are fixed assets. That is why I don't want to use that account. Let me instead open creditors account, trade creditors now, not equipment, trade creditors account. And we are saying that the creditors, this is the effect. C, our C is paid creditors by a check of 7,900. So we debit creditors, we credit bank. Yeah. So we have the creditors account. So we have, what's the amount? 79. 79. Then creditors account. Then bank account, we have creditors. So you can see what is happening. For every debit entry, we have a corresponding opposite entry. So we go on. Then I have D, received from debtors, 8,400 by check and 600 by cash. So the first entry is we debit bank, 84, and debtors, 84. So 84. Debtors, we have a debtors account. If it's not there, we generate. So we have debtors popping up. So you need to have a debtors account and credit it with bank. And it is worth 84. And we need to look whether we had a balance brought downward for the debtors. Oh, it's there, 57,700. So I need to recognize that balance brought downward. And because debtors are assets, don't know what has happened. I'm saving instead of copying. So control copy, they'll be debited. So I'm debiting 57,700. So there we are. And then the final transaction is our debtors. And then the final transaction is on this transaction head 2. So we have another book that is affected. We have cash of 600. So we have cash account and debtors account. So do we have a cash account? Cash account not existing. So I need to generate. So you can see what is happening. If the book is not existing, I just generate. So you have a cash account and it's being affected by debtors. We need to see whether we had a balance brought downward before any subsequent. Yeah, cash had balance brought downward of 400. So I have a balance brought downward. Allow me to copy paste, copy, paste. That is 400 before we do this particular transaction. So debtors are being affected. So we have debtors. You are paid by cash. Of 600. So I'll go to the debtors account and they are being paid by a cash of 600. So that is the corresponding credit entry. And the last but not least transaction is on received from debtors. No, the last one is E, put an extra 25 cash as capital. So I'll go to cash account. Cash is assets. When assets increase, we debit. So the corresponding account is capital. We are increasing capital by 2,500. So do you have a capital account? We don't have, so I generate. So this capital account. So you can see what is happening, guys. If the book is not existing, I generate. And this had a balance brought downward. So a balance brought downward of, this is what we calculated. What was it? 300,000 and something. This is the amount of capital, 330, 800. So 330, 800, 800. Then I have cash of 2,500. I think that's all. From the look of this, I have not indicated the, you have to be very thorough. We have the creditors. Creditors, they were, didn't have creditors somewhere. Yeah, they are now 39,500. So this is the balance I didn't pick. 39,500. Good downward. There we are. I have journalized. Do you have any question to this end? Kuna swali? Now from here, you are supposed to balance your books. Once you do that, you are supposed to balance your book so that you get the balances that you are going to take to the balance sheet. You've been asked to prepare the balance sheet. And the reason why you are being asked to prepare the balance sheet, our assets should be equal to liabilities plus capital. Kwa hivyo kama kuna makosa tumefanya, our books will never balance. That is the catch. So if I look at your journal entries at this point, na niona unajua ile kitu unafanya, the good thing about accounting, even while I'm marking, this one will guide me. I'll know the student who is doing the right thing. Once you scoop this, in a question of 20 marks, I could give you even 12 marks in journalizing only, because everything else that you are doing here is manual work. What is involving your mind is this. So what is involving the mind will carry more marks than what is involving the, yeah, just manual. Anyone can do this. So we can balance, and balance is just getting the totals. So this is 128,800. So you look at which side, it should balance at 128,800. So because we don't have any figure here, this will be our balance carried downward. So this is what will be, this is the figure that will be taken to the balance sheet, 128,800. We go on, we are balancing the books. This is 13,800, the equipment creditors. So you can just balance them. When you don't have any other entry, you just balance in the first line. So 13,800, 13,800. So I'm balancing the books. Here we have two entries, which is totaling to 67,200. 67,200. So my balancing figure will be 67,200. And this will be my balance carried downward. Balance carried downward of 67,200. This is the figure I'll be taking to the balance sheet. Then I have, now this one you have to look at which side is having more. Obviously, this side seems to have more values. So the total is 81,200. My balance in figure will be the difference. Balance carried downward will be equal to, now this is 81,200. So the balance in figure here will be equal to, let me see the totals here. I can just use the formula because I'm using Excel. Minus this, minus this.
I think the balance is 67,600.
Wonderful, 67,600. Yeah, we go on. The balancing figure here is 39,500. So what's my balance carried downward? My balance carried downward will be equal to this minus this. So it's balancing at 39,500. Go on. This seems to be more. So my books will be balancing at 57,700. So this will be equal to this minus 8,400 minus 600. 48,700. We go on, we are almost there. Capital, a cash account. We didn't have a balance. We didn't have a, we had cash. Oh, it's 400. We had already picked that. My books here are balancing at
3,500.
3,500. 3,500. So this is my balance carried downward. And the last but not least, the books are balancing at
330, 800. So
no.
the balance carried down is 333,300.
333,300. There we are. Any question? Actually, that was not the question. The question of the examiner was we prepare a balance sheet. So we are yet out of the woods. Yeah. The question was prepare a balance sheet. Can you prepare the balance sheet down here? It's easier because we have the balances now. So balance sheet is called statement of, just do it together. Do it from this. Called statement of financial position. As at the duration was 7th December 2002. Yeah. So how do we prepare the balance sheet? Yes, Brian. Brian, you are raising your hand. Brayo. Or you are not aware. You are raising the hand. I like students who talk to me. Brian. Don't want to talk. So we start with current, with non-current assets. Or the fixed assets. And here we put amount. So we start with the non-fixed assets we have. We have the equipment, right?
Yes.
What's the value of equipment? Sasa unaenda mahali, I want you to show you. You work with the balance that you are carrying downward. So you can see the value for equipment is 128,800. Sawa sawa? So we'll talk of 128,800. The next one is MV, the motor vehicle. What was the motor vehicle? The motor vehicle was not affected. The value of the motor vehicle was? Motor vehicle.
62,900.
Yeah, 62,900. Guys, you are supposed to be opening this question on your end for us to move quickly. 52?
62,900.
62,900. Do you have any other non-current assets? We don't.
No.
We can just get the total. The total is 191,700. So 191, we just put down here, 191,700. Then we go to the current assets. Give me the current assets.
Stock.
Current assets. We have stock. So we can go up and get the figures for stock. So we look at the stock journal. So stock journal is having a balance carried downward of 67,200. So that's the figure we take to the balance sheet. We put it on this column. We have said 67,200.
67,200, yes.
Which other assets do we have? Current assets?
Cash at hand.
Cash at hand. Before cash at hand, we try to adopt what we call the liquidity.
Excuse me, I have a question.
Ask.
Is that a question?
Ask.
I'm saying we have two accounts for each item.
For?
Which one will you know is the one that you're supposed to put on the balance sheet?
I'm not getting. We have two accounts for
each item, the credit and the debit side. So how would you know which side you're supposed to put? I'm saying we are only using, like now we are getting information from one account and not the other. How would you know it's the one you're supposed to use?
I take you back. Let me explain. The reason why you are journalizing to know all the transactions that are affecting our equipment, right? So once we journalize and we close that book, what we take now to the balance sheet is the balance carried downward. That is the figure that we take. All along, we are going to take the balance in the subsequent account, and you'll see we are taking the balance carried downward, not brought downward, carried downward. This is the figure that we are, that's why it is called carried downward. Actually, now the reason why I don't want to confuse you, actually, I can even come here and say balance
brought down.
You see, now will be, this is the balance brought downward. So when I'll be opening the subsequent book, I'm going to have this, but we are now closing the accounts. Tumeelewana?
Yes, sir.
Okay, so we are taking the balance. So the figure that you are seeing here is balance carried downward in all the journals. This is the figure that will be transferred to the final book of account. I think that is now clear. So you said that we are arranging our assets in order of liquidity. So we started with the creditors, and then we started with the stock, and then the debtors. Our debtors, so you can see the figure that we'll be picking for debtors. It is balance. I didn't indicate.
Carried down.
Sorry, this should be balance carried downward. So we are picking this figure because it is our balance carried downward. So we are taking 48,700. Sorry, 48,700. We go on. Then from there we can now go to the cash at bank.
Okay.
What was the cash at bank?
67,600.
67. I want to see it. 67,600. So 67,600. then we end with cash. You can see we followed the order of liquidity. Cash is more liquid than bank. Bank is more liquid than when the money is in the pocket of debtors. And I'd rather the money is with the debtors instead of the money being in the stock, which are in the store. So what's the value of cash? Our cash is 3.5. That's all?
Yes.
Then from there, we now go to the current liabilities, right?
Yes.
You can get the total here. The total is 187,000. Allow me to put this amount in bold. Then we go to now the current liabilities. Let me just denote them as CL. What do we have in the current liabilities?
Can you say creditors equipment?
Wonderful. We have creditors on equipment. On equipment. What's the value?
13,800.
13,800. And then we have the usual trade creditors, right?
Yes.
What's the value of the trade creditors?
31,600.
31,600. Do you have any other liability?
No.
We don't. So we can add these two. We are getting 45,400. Now we need to get the, let me monetize this. We need to get the, we need to get now the balancing figure. Yeah. So to get the balancing figure, we need to get the figure of our net assets because it should be equal to the figure of the liabilities plus capital.
Capital.
Isn't it?
Yes.
And we already have the balance figure, don't we?
We have.
We have the balancing figure. Will give us the balancing figure. What's the value of capital?
333,300.
So that's our balancing figure.
333,300.
No, numbers don't lie. Yeah.
Yes.
So that is our balancing figure. Yeah. So these are, to get the net assets, I can get the net assets by subtracting net assets. I get this by subtracting my, these are current liabilities. So to subtract, I'll put them in bracket just to show that I am subtracting. Yeah. So what is 187 minus this? 141,600, right?
Yes.
141,600, and then I had this figure. Should have moved this figure. Yeah. Has it balanced?
Yes.
Monetizing this. So we'll get this figure. We add this figure to get our balancing figure. So our balancing figure is equal to this figure plus this figure. And it should give us the same figure as below. So you can see our books have balance, and that's why it is called a balance sheet. Any question? So that's how you are supposed to maneuver. So the carry home here is to know that when assets increase, we debit. When they decrease, we credit. All capital and liability items, when they increase, we credit. When they decrease, we debit. That should be your take home. So I want to stop sharing and go back to the notes. Unless we have a question. I'm able to stop sharing.
Excuse me, sir.
Mm-hmm.
Can't creditors on equipment be just, can't it be put as creditors alone? So
No,
that we can just have creditors in total.
it cannot. In
You
the
have
best
to specify.
in the best practice, you see creditors on equipment is to say, you know, equipments and trade creditors are different things. Equipment are non-current assets, isn't it?
Yes.
And we said non-current assets or fixed assets, they are not bought for resale. They are bought to help generate revenue, isn't it?
Yes.
Trade creditors are on items that we bought to resell. If we mix the two, we are going to have a confusion. There is no problem in mixing the two, but it's a bad practice. So I'm saying the best practice is to differentiate the trade creditors and the creditors on non-current assets. Is how?
Yes.
Yeah, it is in good practice. You know, accountants are supposed to be precise so that when the auditor comes, for instance, if the auditor came and you had combined these figures, and then the auditor is trying to look at the stock ledgers or the books of purchases, and they are not seeing this extra figure of 13,800, you will have a headache. If I'm the one who is auditing you, I'll give you a hell of a day because of bad practice. You get? So later
Yes.
on, when you people will have learned at the advanced level, we will meet in the advanced financial accounting too when you'll be in 4th year, and you'll see how significant these things are in auditing. It's our.
Yes.
Don't mix the two.
Okay.
I want to stop sharing and go back to my notes. Now we are done with that. The other items that, well, there are those, there are a lot of, for you to be good in accounting, you have to do a lot of practices. So I'd urge you to pick the questions that I'll be sharing a lot of practical questions. But the other items that are not, they are neither assets nor liability or capital items, but they affect our books of account. And that's what I want us to have a look at. Now, we have what we call the sales, the purchases, the incomes, and expenses. So I want us to start with the sales. Now, sales, when we buy stock are current assets because we are buying them to resell. So the nature of a stock is we buy to resell to generate revenue. Are we there? So they affect sales. In other words, we are saying goods that were purchased and they used to be resold are called stock. And therefore, when we are talking of goods for resale, they are divided into cash and credit sales. There are those who will adopt cash sales. There are those who will do credit sales. So when a cash sale is made, we have two entries. The double entry will be our cash will increase because we are selling at cash. And this will be either cash at bank or cash in hand. Most businesses nowadays will even tell you to pay through M-Pesa. M-Pesa will be linked to your bank account. So it is cash, yes, but that cash will be sent to your bank account. Are you getting? So cash increase, we debit. So you can see we are coming back to our rules. When cash increase, we debit. But now our sales account, sales, because we are selling on credit, we are going to affect the sales account. So we are going to credit our sales account. Are we there? When we sell, that is when we sell on cash. When we sell on credit, instead of affecting instead of affecting now the cash account, we are going to affect the debtors account because we are selling on credit. My system is telling me my network is unstable. But you can hear me, isn't it? Can you hear me? Am I
Yes.
audible? So I've said sales is of two nature. When we sell in cash, cash increase, we debit cash account. Then our sales account is credited. So we are not decreasing sales. We are crediting the sales account. So kindly understand. So when we sell on credit, the second transaction, we debit our debtors account and we are going to credit the sales account. In other words, we are saying that we are going to add an extra account to our journals, which is called a sales account. The same things happens to purchases. When we buy goods from the supplier, purchases will be affecting our cash or credit, depending on the mode of transaction. So when we buy, our purchases are going up, we debit the purchases account. But if we bought in cash, our cash will be depleted. So when cash decrease, we credit. So for credit purchases, of course, we are going to debit our purchases books and we are going to credit the creditors because our creditors are now decreasing. Are we there? Again, a new account will be opened called purchases account. So we have added two accounts. We have added purchases accounts and we have added sales account. We go on, then the other item is income and expenses. Now you realize a business may have other forms of generating income. Maybe you have a building, you're operating at the ground floor, or the other floors you are letting out, so you are receiving rent. That will be an income. Yeah. Or let's say you have opened a fixed deposit account where you are earning interest. Yeah. Or you went to buy and you received a discount. That is an extra income that you didn't have. So in these scenarios where you are getting extra income, your cash is increasing, whether at hand or at bank. So when cash increase, we debit. It's a current asset. But your income is also increasing. When income increase, we credit. You can see the double entry. We increase cash, we debit. We increase our income, we credit. Then expenses will be coming in handy. And there are those expenses that are not related to the business. For example, maybe postage and stationery, you are printing here and there, telephone bills, motor vehicle running expenses, you are maintaining the vehicles, bank charges, etc. Those are expenses. Expenses are debited. And because they are depleting our cash will go down. So our current asset or bank account will be decreasing. So we debit the expenses, we credit the cash at bank or cash in hand. In summary, this is what is happening for income and expenses. These two are spelling, supposed to be an expense. So this is what is happening. For income, you can see what is happening. They increase our cash. We debit the cash book or the bank account. We credit the income. So all incomes are credited. Expenses, they are debited. And because they are depleting our cash, whether in bank or at hand, we are going to credit the cash account. Any question? So far I have added 4 books. I added sales, I added purchases, I've added incomes, I've added expenses. Now I want to introduce another term, return inwards and return outwards. When we buy goods, let's say for example, you are an egg vendor. So in the morning, you'll go to your supplier, pick a tray of egg. When you reach your destination, you realize that you have 10 breakages. So you cannot cook or you cannot boil broken eggs. They will spill over. So you won't have any sales, isn't it? Now, when you return them to your person or the supplier, we call them return inwards. So return inwards are goods that have been returned by the customer due to various reasons. For example, they are defective, they are expired, they are of wrong type, or maybe the delivery van brought in more merchandise than we expected. Are we there? We call them return inwards. So what will happen to the return inwards? I'm waiting it to sink at the back of your mind. So when goods are returned, of course, they are going to affect either the cash or the credit sales. Yeah. So for the goods return in relation to cash sales, the cash is either refunded or you are given other goods. So what will happen? We are going to debit our return inwards and our cash is going down, so we are going to credit the cash. Now the opposite is true. Yeah. So for goods return and they relate to credit sales, we are going to debit the return inwards and credit the credit debtors. I'm saying the opposite is true. When the goods are now returned to suppliers, we call them return outwards. The first case was return inward. I always tell my students, assume you are the business. It's easier that way. So assume you are the business person. So when you are returning outward, what is happening? You had used cash. So you are affecting your cash. So what will happen when you are returning outward? You are going to collect the cash that you had given for the purchases. So your cash will increase, you are going to debit your cash. But your credit return outwards will go down, so you are going to credit. Are we there? That is when you transact on cash. If you do it on credit, it will be the opposite way. So we are going to debit our creditors because they are decreasing and they are increasing, sorry, and we are going to credit the return outwards. Any question? It is easier said than done. That's why we have examples. Any question? So this is how we treat the return inwards and return outwards. So you can see what I was saying. If they are cash in nature, we debit, return inwards, we credit the cash book, or we credit the cash account. If they are of credit nature, we debit return inwards account, we credit the debtors account. And if they are return outwards and cash of nature, we are going to debit the cash, credit the return outwards. And if they are credit in nature, we debit creditors simply because they are increasing. Are they increasing or decreasing? Return outwards. Our creditors are decreasing because we are the business. When we take it out, we are going to debit and we are going to credit the return outwards account. I want to bring an example. So we have an example here. This is a worked example. I want you to go through the worked example. I don't know whether we have an example here that is not. Can you go to the portal? Just go to the portal and see whether I have attached any. Someone to tell me whether we have any question in the portal. Do we? Are we still there, or we? Why are we quiet? Brian, you're still raising up your hand. Any question? I want you to go to the portal. I want us to interact from the portal. So tell me when you are in the portal. Something I want to actually stop sharing. Move people from this side. Go to the portal. Can you go to the portal, please? and answer me. There are those few questions I've asked there. Are you people told, or do you realize that when you interact in the portal, you get marks? By interacting with the portal only, you are going to get 20 marks for my class. So you can imagine. Yes?
Are you saying the questions on the discussions?
Yes.
Okay.
Can you read what is there?
What is your understanding of dual entry concept?
Yeah,
Those ones.
Yeah, fair. Then I'm posting a question there. That's why I want us to interact in the portal. I'm posting a question there.
Oh yeah, because it's saying there's no discussion topic yet in this forum.
Oh, there is a discussion. What about what you've read? You read me a question, isn't it?
Yeah. Oh yeah, sure.
I'm posting another discussion. Just answer what is there first.
Okay.
I'm looking for a question on my end. By just doing that, you get 20 marks. No student don't know, they don't understand the importance of being in the portal. You are getting free marks. That's why you are supposed to always go back to the portal and see or respond to what has been put there. You are getting free marks. For doing that, you are getting free 20 marks. So you are already having 20 marks. You are looking for 80 marks to score 100. The university, you don't need 100 to score an A. You just need 70. So you're already looking for 50. You already have 20, you are looking for 50. If you get cut 15, you'd be looking for 35 in the exam to score an A. And people still fail. So I don't expect someone to score a D in this class. I'm trying to look for a question, a reasonable question. Are you responding to my questions?
Yes.
Kindly do. How do you like that speed? Are we so slow? We need to increase the speed.
No.
No, the speed is good. At least you understand something.
Okay.
Okay.
Excuse me, sir. Are we doing the discussion like right now?
Yeah, it's live.
Okay.
What have you been waiting for? You know, I'm waiting for your responses.
I thought you were posting another question now.
No, yeah, as I wait, I'm waiting for your responses so that I put another discussion.
Okay.
What's the discussion?
Interaction when the classes are going on.
Exactly. It's supposed to be back and forth. Answer me. Have you answered my questions?
Yes, I've posted.
Okay. I'm looking for a question on this end. I was answering that person who has asked whether we are doing it right now. I'm looking for a balanced question. I just have either the question is having a lot of gaps. I'm trying to look at a question that has everything, that has sales, return outwards, return inwards, everything.
Is there a deadline for this discussion?
Should be live. The meaning of live.
Yeah.
Live means now. Supposed to be in the course of this class.
Okay.
All discussions are supposed to be live. If they don't happen in this class, they will not be discussions. They'll be something else. I'm trying to look for a serious question. I can't get. Either the question is out of scope Anyhow, I look for a question and post in the course of the week, right? Because the questions that I have here, they have a lot of, they are sophisticated.
So
Mhm.
it will be our assignment or
No, it's for your practice. It is for
discussion
your
still.
no, it is for your practice.
Okay. Okay.
So allow me to end the class. I'll post the question later on, right?
Sure.
So you can enjoy your weekend.
You too. Thank you.